As a result of positive CPI data, we saw the traditional markets as well as cryptocurrency markets rally towards the upside. This rally was strong enough to enable both markets to break out of their macro diagonal resistance, this resistance being the bear market resistance. The question is, with FOMC just around the corner, will we see a continuation to the upside, and will FOMC facilitate that move, or will FOMC be the nail in the coffin needed for Bitcoin to take that final leg towards the downside? Let's dive in. Okay, what is going on, my God team? Welcome back to the channel, guys. I hope you're all having a fantastic day. And what a crazy 12 hours has been in the cryptocurrency market and just the market as a whole. CPI coming out better than expected. The market saw a decent rally to the upside. These rallies have broken through some major trigger levels on the short-term time frame as well as the macro time frame. We're not going to discuss too much about the technicals today. There's no real point jumping into technical indicators, as these usually get thrown out the window as soon as economic news comes past. Economic news, like we said before, is the driver of price action, and it can manipulate and move price no matter how bearish or bullish the indicators do look at the time. Instead, we're going to be focusing on points of key interest on the larger time frame as well as the smaller time frame for rejections, continuations, and confirmations in macro reversals. So we're focusing a little bit more macro today. Now, before we get into a special like button, comment down below and subscribe to the channel if you are new here. We do daily analysis for Bitcoin. And of course, guys, if you are interested in the Telegram channel, it will be the second link in the pinned comment section down below. Get access to all of our charts, updates, news, analysis, information, and a lot more stuff in here for you guys on the daily. Let's go ahead and dive in, and we'll start with our market data. So for the daily, we have seen Bitcoin print a nice strong 1.55%. That is pretty strong for Bitcoin, considering the whole entire month has been pretty bad. And what we are seeing for the first time in December is we're seeing December turn green. It's taken about 14 days. Been mostly red. We're starting to see some positive price action. We're starting to see some green for December. Of course, 3.55 is not strong enough for us to delete this quarter four red quarter. We need the price to get over 19,000. I think it's like 19,100. It's very close to 19,000. So obviously, if we are unable to get above 19,000, the quarter will close red. And that will be the first time in history that Bitcoin has seen 4 consecutive red quarters. But 19,000 is more than just a point of which we're going to turn green for the quarter. 19,000 is a very key trigger point, and it's a confirmation point for a macro reversal that we'll actually come back and talk about later in the Bitcoin analysis, because 19,000 actually represents that POC level, the point of control, the area of most historical trading volume within the last 4 to 5 month range. And this is the area in which we do need to break above, because it's indicating a lot of resistance. Once we break major resistance becomes major support. That could be the trampoline needed for us to continue back upwards for the markets. Moving on, volatility has seen a little bit of a move upwards in the last day. Of course, we did spike down to about 1.58 temporarily in yesterday's video. We ended up around 1.65, and of course, we should start to see volatility rise over the next few days now to account for the rapid surge in price we just saw over CPI. So we can expect volatility to start rising. Of course, with rising volatility, we see rising volume. And obviously, if we see rising volume, we see more and more liquidations. So it looks like over here, we had a lot of late longs. They've been liquidated on the way back down. A lot of shorts got liquidated on the way up. A lot of longs got liquidated on the little kind of reversal at the top we saw from 18,000 back down to about 17,500. We saw some degree of a pullback. I think a lot of people would have entered the market late there on longs and would have got slaughtered. So either way it goes, guys, we've seen some volatility come back to the market. We've seen some price action come to the market. And let's discuss and talk about the implications that it's had on cryptocurrency. But more importantly, we'll start with the broader markets. So the DXY has done basically what we were expecting. We said that, you know, as long as if we do not get above this major support level, we are going to get a retest and rejection from this lower support. And we've said the next target for the lower support, as we've been saying for the last 3 months now, that target was 103.78. This exact horizontal line we've had in our charts for like 3 months. As you can see, we've basically perfectly retested this on hourly. We did not even close the hourly candle below that. You can see it's touched it by the skin of its teeth and pumped back up. So this is a key potential bouncing point for DXY. As we know, if the DXY goes up, cryptocurrency, stock markets go down, and we saw the DXY crash a lot on the CPI data. And that is why we saw, again, the markets reverse simultaneously. It happens at the same time. They're not direct influences, meaning because the DXY drops, it doesn't mean cryptocurrency goes down. It just, they happen inversely at the same time based on the strength of the US dollar. They kind of happen at the same time. So it's the opposite reflection of that price action. So obviously with FOMC, we can definitely see this shifted a bit again today. If FOMC comes out positive, we'll talk about that in the video in a second. If that comes out positive, we'll see some bullish price action for markets. We will see this fall back down. Comes out negative, we will see the DXY rise upwards and the markets fall down. Total cryptocurrency market cap we'll come back to. This is where it gets interesting. The Dow Jones actually broke over that key trigger point we're talking about for the last few weeks, if not longer, which is 35,000. 35,000 is the bullish trigger for a continuation upwards to retest the high. Okay, 35,000 is the bullish trigger to retest the high, meaning we need to get a daily above, we need to remain above, consolidate above, and push higher for that to enable to occur. Okay, all in all, the structure is looking bullish. We've been saying this for a while. The structure is looking bullish. On the larger time frame, we broke out of our macro bear market resistance quite some time ago. We've been flirting upwards. We broke through this horizontal level over here. We were looking a little bit sketchy over here for a brief moment in time, but we did have the support level here. Again, if we do lose the support level, we're coming down. But until then, we are in this neutral pattern over here, the standstill area where we're kind of waiting to see what happens. We're waiting for that break upwards and close upwards, or we're waiting for that loss of that trend line. Nevertheless, the directions are very clear for this structure. S&P 500, similar thing. We broke out of the bear market. This is the bear market right here, guys. This is the bear market resistance. We can see the bear market resistance, a descending, expanding channel. A wedge, sorry, descending, expanding wedge. And we can see we temporarily broke through that resistance, and currently we are back under. What is that telling us? Well, it's telling us that that FOMC, guys, is going to be crucial in determining the macro projection for the markets. Okay, CPI came in good, and we know CPI coming in good is a good thing because it tells us that FOMC might be decent, it might be good, right? If we saw CPI coming really, really bad, okay, inflation was up, we'd expect that, you know, the chance we see a 75 basis point hike would have increased, and we'll take a look at that in a second. So let's go ahead and jump into that now. So the next economic news event, guys, is of course at, where is it, 2 p.m. UTC -5 time. That is quite some time away from now. I think it's a little bit over, I'm just trying to calculate the time ahead. Oh, here we are, 14 hours. So if you're in Australia, that's pretty early in the morning. You know, we're looking like 4:30 or I think it's like 4 a.m. in the morning. If you're in America, it's like 2 p.m. UTC -5 time. So keep that in mind. Now, if we look at the data over here, we got a 74.9% expectation for 50 basis points and a 20.6 expectation for 75. So prior to CPI, this was around 73%, and this was a little bit higher, around 25%. So we've definitely come down in that expectation for 75 basis points. So what do I think is going to happen, and how would I react? If I see 75 basis points or higher, I think it's an immediate short. If I see 25 basis points or lower, that's an immediate aggressive long. At 50 basis points, I'm going to be neutral, and I'm going to wait again for these larger time frame triggers to play out. For example, on the Dow Jones, we're waiting for a larger time trigger. For the S&P 500, we're waiting for that larger time trigger, which is confirmation above this level and clear of this high over here, and just follow the trend, okay? Bitcoin, let's get into it. So for Bitcoin, for the larger time trigger, we need to get above this June low. Getting above this June low, guys, will confirm this entire move towards the downside was nothing but deviation on the large time frame, caused, or to some degree, caused by that crash of FTX. Now, it gets a little confusing here, and there's a lot to talk about. There's so many different angles you can attack and talk about this topic. we're going to kind of break it down into a few. We're going to talk it from the bullish case scenario in terms of what macro structures do we need to break, what macro technical indicators do we need to see, or what technical indicators can we use to get confirmation in the fact that the macro chart has reversed or is in the process of reversing. We're going to take a look at the smaller time frame and to talk about small time frame triggers. Then we're going to look at the Brave New Coin Liquid Index, talk about the 4-year cycle, talk about the limitations of the 4-year cycle, and more importantly, talk about what the 4-year cycle is suggesting and where the price can go based on that. So 3 different scopes. So we'll start with that larger time frame. So as you can see, guys, on the larger time frame, Bitcoin has very clearly now broken above this descending trend line. This ascending trend line is in fact the bear market resistance. Okay, we're very clearly broken above this bear market resistance. We're sitting just above it now. Okay, we're on our second daily close above, so it's looking decent. Now, as we already know, guys, patterns form in patterns and develop around patterns. So the next pattern we have developing at the end of this descending channel structure is what we call a falling wedge. Now, a falling wedge is a bullish reversal pattern, okay? They are bullish reversal patterns where we have this downwards consolidation in price with a downward sloping resistance as well as a downward sloping support, which are converging as the time moves along, meaning they're getting closer and closer to another. What this suggests? It suggests slightly downwards consolidation and compression, which eventually results in a continuation upwards. As what it does suggest, it suggests that support is gaining strength, okay? Selling volume is decreasing over this period of time between these support touches. We're having decreasing selling volume or selling pressure. So we do expect a reversal from that if this pattern does play out. Now, from a technical standpoint, what are we looking at for confirmations? And from a structural standpoint, what are we looking at for confirmations? So first and foremost, so let's talk about that $19,000 level. For confirmation of a macro reversal, we need a few things. The first one we've already had, which is a breakout of this descending macro trend line. The second one is a break above both the POC level, which represents the highest point of historical trading volume within the periods between June to November. As you know, this is like a 4-month-long support, a very strong support, as well as the downward sloping resistance of the market structure between June and date current. So we need to break that horizontal, we need to break that diagonal. Once that occurs, we have technically flipped this market structure as well as this entire 4 to 5, 6 potential months long consolidation zone, indicating that the macro chart is developing a macro reversal and a reversal is taking place, okay? That is what we're waiting for. There's no need to jump the gun yet. There's absolutely no need to get overly bullish yet, okay? You should definitely be leaning towards the idea that the markets are trying to reverse, they're looking better. But again, FOMC can throw a massive spanner in the works. If FOMC comes out bad, we can definitely go lower. We'll talk about that in a second. So from a structural standpoint, you are looking for those levels. Let's go ahead and entertain the idea that we break above here. What are we looking for next? Very straightforward stuff. We're looking for a few things, but most importantly, we're looking for a break over this 22,500 to 24,000 level. This level, if we draw it back, is the same crunch zone we saw in December 2020 prior to the massive expansion we had, which would be constituting that first leg of the bull market for Bitcoin. Okay? If we look at the VRPV, we can see historical trading volume significantly drops off. You can see on the side over here, significantly drops off once we start surpassing 24,500. And that indicates a massive, massive drop in historical trading volume all the way up until that $30,000 range. Again, guys, no coincidence. $30,000 is the yearly low for the bull market price action on Bitcoin. You can see the yearly lows developed over here. After that first leg, we retested 30K, we went up, we came down, we retested 30K, we went up, and finally we created this rising channel formation, this bearish structure formation on that 30K level, breaking down below it. Since then, we are now developing a descending wedge. So looking for those key areas of confirmation can result in significant swings towards the upside. So there is no doubt that the macro in terms of a structural standpoint is starting to look more and more favorable. There is absolutely no doubt. You can go look at Bitcoin, you can go look at the traditional markets as we've already shown you. There's absolutely no doubt that we're coming up to points of potential major reversals. Okay, now that doesn't necessarily mean we can't go lower. We'll talk about that in a second. But what it does tell you is that you should not be blinding yourself here to the potential of macro reversals. The lower and lower and lower and lower we go, eventually the risk return for longs get more favorable and more favorable and more favorable. At some point the bottom is going to be in. No one knows exactly when that's been. It could already be in, and at some point you're going to make the decision to either get into the market or stay out of the market. But your most important decision is not the lowest price you can get in. The most important decision to make is what is the best time I can purchase the lowest risk available? What is the lowest and cheapest price I can get with the lowest risk available? And that point is the point where we have the most macro confirmation for a reversal. In my eyes, that point occurs anywhere between 19,000 and a break above this level. Okay, at that point would be the point of lowest risk and best possible upside, as well as enough macro confirmation to validate these moves in terms of, you know, being a logical and informative decision. So let's take a look at some technicals, because there's more than just structure. Like we said, there's some technical indicators on these charts that are telling us some really important pieces of information. The first one being the weekly RSI. If we take a look at the weekly RSI and draw our trend line across, we can see something really, really interesting here, really, really important stuff. We are actually retesting this RSI downtrend, okay? Meaning, we have broken out of the downtrend on the chart, but momentum is not quite out of the downtrend yet. So this right now is not enough confirmation, like I was saying before, to confirm the breakout. With FOMC around the corner, there is still potential we can reverse. But breaking out of the price action diagonal, as well as shifting a macro diagonal resistance or diagonal point of contention on the RSI, what that does indicate, it indicates a shift in RSI to the upside, can be the confirmation that you need for a breakout. Okay, so we're looking at that level. Incredibly important piece of information, incredibly important analytical tool to actually determine whether or not this move is a fake out or is going to be a confirmed breakout. Again, you may decide to enter once you see that RSI break. For you, your own personal risk tolerance, that may be all the confirmation you need. Okay, the more pieces of confirmation we apply to the charts, the more confident you are in your decision, the lower the risk, but again, slightly lower reward. Moving on from there, another really important piece of information is going to be the 50 EMA on the 2-day chart. The 50 EMA on the 2-day chart, incredibly important. Reason being, we have never seen, well, in the bear market, we have never seen a cross of the 50 EMA while the price is above the bear market resistance. We saw a cross of the 50 EMA, the price was still below the bear market resistance and got rejected. In this instance, we saw a rejection from both the 50 EMA and the bear market resistance. In this instance over here, the price is now above the bear market resistance, but below the 50. Again, if we cross that 50, guys, we're crossing the 19, we're crossing that downward sloping resistance. That is, of course, confirmation on the macro that not only are we out of the bear market, not only have we broken out of a 5, 6, 7 month long downward consolidation zone, but we have also flipped the 50 EMA on the 2-day, indicating the trend is now positive on the medium-term time frame. And again, that can translate into macro reversals. If we go ahead and take a look at the 50 itself, every single time, or if not almost every single time we cross over the 50, okay, we start seeing significant moves, okay? Significant moves. Every time we lose or cross over 50, we start to see significant moves. And again, the 50 is one of those tools that can dictate or tell us the strength of the trend, okay? So it's a very, very important technical indicator to use, and very important moving average to use, because it's not really a slow moving average, it's not really a fast moving average, it's kind of in the middle, so you can catch potential macro reversals before they start occurring when you're using this one. So guys, that is of course a bullish scenario on the macro. If we go back to the smaller time frame, looking for an honest, reliable and accurate exchange that you can trust to trade on, go ahead and sign up to BitGet with the link down below and join myself and all of our other VIP members and other members who trade on BitGet daily. There's a whole range of benefits and features you can actually get by trading on BitGet. These include no government regulations, meaning you can sign up from anywhere in the world. There's no KYC, 0% trading fees on spot, massively reduced trading fees on futures. It's one of the lowest in the game. And most importantly, access to their protection fund in case the exchange gets hacked. You can actually get reimbursed for your funds so you can ensure your funds are safe. Now, most importantly, if you do sign up with the link down below, that first link, you'll get access to 2 additional features. These include access to a reward center where you can get up to $4,163 in rewards, and access to the Mega Whale exclusive referral link, bonus discounts. Every other month we do bonus campaigns. We get up to 10% off your trading fees, or even you get a percentage of your trading fees refunded to your account as USDT. Essentially, you get paid to be on the exchange. That's enough, guys. We'll get back into the video. We do have resistance above us. We've been saying this for quite some time. We said on a smaller time frame, you've been paying attention to the channel. We've said, guys, for the move upwards, we need to break above this local high. Okay, I'm gonna go ahead and delete this line over here. You can see the local high was, of course, at December 5th level, all the way back to that December 12th level. We will need to break above that level to see a swing high. We saw that CPI facilitated that. Congratulations if you got into a long at that point. We saw that break. We continued towards the upside. Very nice to see. There's a few problems right now, however, on a small time frame. We are still technically within this rising channel formation. Okay, we are still technically in this rising channel formation. As long as we are in this rising channel formation, we are still bound to the potential negative breakdown that this rising channel could facilitate if this trend line is lost. Of course, this is a pretty nasty fake out over here, but it is what it is. Sometimes price action does fake out. So again, while we remain in the structure, there is always a potential we lose this level and continue toward the downside. The positive is, as we start moving higher and higher in this structure, we start creating new and new supports, and then for us to start losing these lower and lower supports, we have a lot more supports to get through, therefore we may not actually break down to these levels if this structure does break. So that is the one positive thing about that. But we do have to be aware that this structure is still very much valid. We are still in this structure, and this structure is something the bears will be looking at if we do break towards the downside of this structure for lower potential targets. Another thing is we do have that major rejection zone right above us, which is at 18,100 to 18,600 level. Again, that is that June low level over here. This is not the POC level, this is not the 19,000 level, this is the horizontal support level we had between June and November, and it is now going to be extending and possibly acting as resistance. Breaking through this level will be incredibly difficult, but incredibly bullish if it does occur. So watch out for our level for potential rejections and potential reversals. Again, there is absolutely no need to get overly bullish if you are not already in longs. Take a look at this. If you take a long right here, your target is a minimum of 2 to 4%. What is your risk? Well, the risk is essentially all the way down to 15,500. This is not a favorable risk return. Even if you tighten up your risk and bring it down just below this trend line, you are still technically trading at a negative risk reward ratio. If you have to assume that it will go all the way up, you are trading at a positive risk reward ratio, but a 1 to 3.8 is by no means something that you're looking to jump in on all the time. I wouldn't be trading anything that is below a 1 to 2. So even here, guys, longing here is not the best idea in my opinion, especially with FOMC coming out. You should have already had some degree of longs taken that you're sitting on, as well as shorts that obviously would have went pretty badly. But here is not really the best time to be taking. Like I said, if you zoom out your time horizon, zoom out your thinking, you're looking for now macro reversals. Your whole mission now in the market should be macro reversal. When is it coming? How can I prepare? What points on the large time frame should I be looking for? Not these short-term scalps or swings. These are things you can do on the side. They shouldn't be occupying 100% in your thought process. The next thing for the bears is, of course, a 4-year cycle. And the 4-year cycles is neither here nor there in terms of a few things. The first one, that is the traditional 4-year cycle, we see the 16 bars between the bottoms and the bull markets, and we see between 12 to 13 bars from the peaks of the bull markets to the bottoms of the bear market. So we've seen that here, we saw that there, and we've seen it again. So according to a 4-year cycle, we are either bottoming out this month at a new low, or 15,500 in November was already the bottom. But if that was the case, the difference being this time around, we only saw a 77% move down. And according to a 4-year cycle, according to historical data, we usually see about 84. Now, if this is the thing where it gets a little confusing, we don't necessarily have to see 84% of the way down to confirm the 4-year cycle. Because if we factor in diminishing return model, okay, then it is only logical to assume as the prices rise and the total cryptocurrency market cap increases cycle after cycle after cycle, the percentage drawdown from peaks to bottoms are going to start diminishing as more and more money is displaced. For example, you take a $10 trillion market cap and you reduce it by 77%, that is significantly more outflow than a $1 trillion market cap reducing by 84% like we have seen before. So the outflow in this cycle, although so far has only been 77%, the amount of money that has been displaced in this drop has been 4 or 5 times larger than the amount of money that has been displaced in drop, and probably 50 times larger than the amount of money that was displaced in this bear market. And that trend will continue, the percentage drawdowns will continue, vice versa, vice versa. What we can look at as a more determining factor is the date ranges rather than the percentage returns. I'm less interested in the percentage return on the way down than I am in the date range. Assuming that December will bottom, the date range we're looking at is around about March, April, May 2024 for a bull run to start. Assuming November was the bottom, we're looking at a month prior. So we're looking at anything between about March to May 2024, okay? Assuming the bull run does start, at what price will the bull run start? All right, assuming the bottom was at 15,000, we are looking at anything of about a 200% rally according to prior cycles from the bottom to the point of which the price crosses over the baseline on the monthly, which in prior cycles have actually confirmed the fact that the bull market has initiated. That will end up around about, let's take a look, around about 48,000-ish, okay? So a bit, oh wait, sorry, 15,000. Not 14,000, at around 15,000. So let's take a look over here. That takes us to 200-ish%, takes us over 48,000. So we're looking at a price break of the baseline over 48,000 will confirm the bull run has initiated, and that should take us to new all-time highs. And again, that is very reflective to the price action chart. What will need to occur for us to retest these absolute highs? Well, it's very obvious. We're going to need to break these low formations and rejection formations we developed on the upper macro time frame, okay? The low formations we developed in April, okay? The rejection point we developed in April 2022, and the base of support we developed in December 2021. These are levels we need to break to see any sort of continuation to the upside. Again, it is all very straightforward. The data reflected on the charts, the data from the 4-year cycle confirms the data on the charts, the technicals on the macro, the small time frame, all tell us the same thing. And that is, unless something catastrophic happens in cryptocurrency, unless something catastrophic happens on the global economic scale, we are most likely much, much closer to the bottom than many people anticipate. The people calling for 3,000, 2,000, 1,000, 10,000, it can happen according to data. According to the 4-year cycle, 10,500 is possible. But according to structural analysis, according to the technical indicators, according to what we are seeing happen in the economy, according to what we're seeing on the data and the charts, we have to at least not blind yourself to the possibility of reversal. If you blind yourself to the possibility, I don't care if you got a bias towards the bear side, I don't care if you want to see the prices drop, but do not blind yourself to the idea and the possibility that we could see a reversal. Because the last thing you want to do is miss out on the best possible entry you'll probably ever get again on Bitcoin, assuming adoption comes in, central bank digital currencies come in, all that regulation comes in, because you were too worried about wanting to buy Bitcoin a little bit lower, okay? And I'm not saying buy it now, buy it now. What I am saying is wait and being very attentive to what happens over the next few weeks and months, because we're starting to see glimmers of macro reversals popping up. And if these macro reversals develop and flourish into proper reversals, these will be confident and actually good times to be looking to enter in terms of your risk return. Okay, I'm gonna leave it there, guys. If you have any questions, leave them down below. Of course, stay tuned for FOMC. We post all of the data in our Telegram channel, just like we did, guys, just like we did with the data from CPI yesterday. We posted this in the first 16 seconds of the data coming out, okay? You won't get that on traditional websites. You won't even get that quickly on the government websites. It takes a few minutes. So if you want the quickest access to data, go ahead and join our Telegram channel. We post it within the first 30 seconds, usually right over here. Again, there is no way you can trade the information that quickly because of bots, but you can get that information quickly so you can at least plan your decisions effectively and within a quick amount of time. Okay, I'm gonna leave there, guys. I'll see you guys tomorrow. Enjoy the rest of your day. Cheers.